Okay, Andrew Dassori, welcome to the show.
Ty, great to be here. Appreciate it very much. Good to talk to you.
Yeah, long time coming on this one. And Andrew, for listeners, Andrew is an investment professional. He runs a mutual fund called Wavelength Capital. And Andrew and I met in New York. We met together to do this conversation in New York months ago before coronavirus. And we thought it would be more appropriate and interesting to redo it, considering the craziness that has transpired across the board since COVID has hit. So Andrew's nice enough to do round 2 here, and I'm going to let Andrew introduce himself so I don't botch his resume.
I appreciate it. I was going to say we probably met 25 years ago in the backyard.
Right, that's a key detail.
Playing wiffle ball, but yes, have been friends since. So I'm definitely happy to be on the podcast and happy to go through my background briefly here. And I think sort of from the top down, I've always been interested in investing. So that's a key thing to highlight. It's been an interest, maybe not since then, but since I was 18, I opened my first brokerage account on my 18th birthday, and was fortunate enough to graduate from college in 2007, when you could still get a job as an analyst at an investment bank, to really live through the financial crisis as my first work experience. And that's, I guess, for those who don't know, an investment bank is basically a financial intermediary helping companies and individuals in how they invest and how they issue stock, all types of financial transactions, making markets. And I had joined Credit Suisse in their fixed income and equities training program. And then after a few years became a portfolio manager in their asset management division.
Yeah. So Andrew, I'm going to cut you off. As I understand an investment bank is, if let's say I run a company that manufactures radios and we're interested in potentially buying a competitor business, I would engage an investment bank to help me understand how to value that business that I'd like to purchase. Is that relevant?
Yeah. Yep. So it can be advising on mergers and acquisitions. It can be advising on an initial public offering, so making your own company stock available to the public. Things to do with debt financing, so issuing bonds. That's another area that investment banks help companies grow and really finance their growth. Any type of financial transaction there. And then on the other side of it, advising people and institutions on how they invest, making markets, offering those financial instruments, whether they're stocks or bonds, making them available to other institutions, to people. That market making side is the other part of their business, but it's any type of financial transaction, you can sort of go to an investment bank for advice on.
Got it. And then tell us about your stint in Nairobi.
Yeah, that's, I think, a key thing, a bit of a departure from my day-to-day job at Credit Suisse, but they sent me to Kenya to establish their relationship with Equity Bank, which at the time was the fastest growing bank in Africa. And that, was different from what I was doing on a day-to-day basis, but was definitely a formative experience for me in terms of being entrepreneurial and adapting to a new, unfamiliar environment. Obviously, being in Nairobi was a bit different from being in New York. And that ultimately helped prepare me for starting Wavelength, the investment firm that I started 7 years ago, to make efficient investment strategies really available to everyone. So that's kind of my full background in terms of going from Credit Suisse, starting my own firm. And that is, the key thing. We manage a mutual fund using technology. I think that's sort of the key thing to highlight there, to do deeper analysis, make more efficient investment decisions.
A mutual fund versus a hedge fund, meaning that a mutual fund is available to the retail investor, to an individual who wants to invest in Wavelength and benefit from their investing expertise. I as an individual investor, could buy stake in your mutual fund. But if it was a hedge fund, that's only available to companies to invest, institutions like banks or endowments or whatever. or hedge funds aren't available to the quote retail investor, meaning you or I, and as an individual, couldn't invest in a hedge fund.
Yeah, so that's a key thing to highlight. Why we launched our mutual fund versus launching a hedge fund. I think that is a very important thing to highlight. We wanted to make our investment strategies available to everyone, regardless of how much money you have. Hedge funds are typically limited to the very wealthy people and larger institutions. So they offer those sophisticated strategies to a more niche group of people, and we thought it's fair to make it available to everyone, which is why we launched our fund as a mutual fund as opposed to a hedge fund.
Got it. Yeah, and so just to back up a little bit, your mutual fund is called Wavelength Capital, and as I understand it, your investing expertise, or at least your focus with the Wavelength Fund, is around bonds. So bonds versus stocks, and you're purchasing bonds on behalf of the investor, and that could be a corporate bond or a government bond or a municipal bond, meaning that rather than me buying ownership in a company, equity in a company, which is what a stock is, I'm essentially lending money to companies or governments or municipalities, and then getting a more predictable return on my investment than I would with a stock.
Yeah, and so I think that does describe it in a clear way, where you think stock, you're owning a share of the company. The bond really represents a loan made by an investor to a borrower, and that borrower, as you said, can be government, municipality. There are lots of different borrowers out there. A little bit different in terms of the return stream you can expect from a bond versus a stock. Obviously, there is the risk that people don't pay you back when you loan the money, but that risk is ultimately priced into the value of the security, and that's really the difference that I would say with what we do versus buying stocks, where the return stream is somewhat less predictable, and the value can come from different parts in terms of the value of the company.
Got it. And so what I really want to dive into today, and as a result of your managing money, you have to be monitoring the global reality economically and amongst the markets. So during COVID-19, obviously things have been in flux more than any of us have ever seen. And so I read your recent letter that you put out, and I thought that it was very informative, first of all, but also could be a good kind of structure for this conversation, because I think it'll be helpful for investors. It'll certainly be helpful for me to just kind of hear you out on what the state of things, kind of the main things that you've observed as it relates to economic activity and market activity, and then also some of the kind of societal and economic shifts you are noticing, and what it might mean from currently, but also going forward.
Yeah, sure. And obviously with COVID-19, the toll has been really devastating from a human perspective, and that, the number of people who have gotten sick, and the tragedy that is that it's impossible to quantify from a human perspective. At the same time, with that, there has been a massive disruption in terms of markets, and that's, and in terms of really the way that it has impacted our everyday lives. You can think of that as the economy as our everyday lives. Been a huge disruption there, where the initial disruption in markets really did sort of mirror that, and you could see a substantial fall off in a lot of financial assets, which is what you'd expect with a sort of devastating global pandemic, where the real remedy in terms of stopping its spread has been shutting down the economy. So since that initial shock, I think it is key to highlight what's been happening has been a bit different, where we've seen a disconnect between how markets behave versus the real economy. We have the highest unemployment rate on record. In the post-war period, we've never seen anything like this, but markets have been bouncing back, really approaching their all-time highs, and that has been definitely a hard circle to square for a lot of people.
Yeah. So the reality of the economy does not suggest that stocks would necessarily be on an upward trajectory as they have been the last couple weeks, especially. And today we're recording is June 1st, just for the record. So what does that mean? Based on what you said in your letter, it sounded like okay, if I'm an investor in certain stocks were at, all of a sudden they were 30% down to purchase a otherwise healthy stock. So as an investor, I'm thinking, okay, in the future, at some point, things will go back to quote normal and this company will still be healthy. Therefore, I'm going to buy the stock in the middle of this pandemic because I'm betting on the future.
Yeah. And so this is something we've done a lot of research around. There's not really one clear answer, but that view of markets being forward-looking, that's the nature of markets. So that is a key thing as to what's been happening, where people are able to look ahead and markets are really able to absorb short-term shocks if they're able to process what's been happening and really realize what the future returns look like. Obviously, markets are looking ahead to a future that is somewhat unknown. The economy will be different coming out of this from the way it was going into it. There has been a massive amount of change that's already taking place, and a lot of that has come through these huge levels of unemployment and really devastating changes to businesses that have been necessitated by this. But that's been that one, that forward-looking nature of markets. That's been one pillar as to what's been happening. Beyond that, there have been other sort of newer dynamics at play. One of those being those existing trends, a lot of the things that we've been seeing in markets prior to this huge disruption, things like large companies taking advantage of their scale, in some cases, companies using technology. A lot of those trends have been accelerating. And I think you can look at how Walmart and Amazon, they've been open throughout the crisis, while a lot of the mom and pop retailers, small businesses out there have been forced to shut down. You're seeing that trend of the larger businesses, which are ultimately the companies that make up an index like the S&P 500, taking advantage of that scale and having an advantage through this to come out ahead and gain market share from some of their smaller competitors. So that's been one big disconnect between the large companies out there versus small businesses, and that's been a pretty powerful impact on things in terms of financial assets. The ones that people look at day-to-day basis are publicly traded companies, not necessarily the small mom and pop stores out there that have been really shut down through this whole pandemic.
Right, shut down, and also with fewer resources to weather the storm to begin with. Even if their doors weren't shut by law, they just by nature of their size don't have the backing or the internal resources to weather a storm like this. Yeah,
exactly. And so that is it's an existing trend, something that we'd seen in the past, but this crisis has really accelerated that massively. And that's been had a very difficult to manage impact on some of the smaller businesses out there, but given a lot of companies that make up the typical indexes that represent financial markets, a big advantage through all of this.
Yeah. So throughout the pandemic, however long it was into it, the stimulus came into play, the likes of which we've never seen, with the government lowering interest rates to essentially zero, making it basically free to borrow money, giving a lot of money to banks to make loans more readily available, even though it's not necessarily easy to get a loan. There's more money out there to give that loan to small business owners. What are your thoughts on that in terms of the scale of it, but also what does it mean going forward? What are some of the long-term implications of it? And maybe also, what do you think? What are your thoughts on how it's been handled in general from the top in ways that it could have been done differently? Or
so what you highlight that's really the third thing that's been impacting markets is public policy. Monetary policy is primarily the driver there that we've seen thus far. Fiscal policy, I think, will likely come next. But on the monetary policy side, we've seen a cut of interest rates to zero. As you mentioned, that's basically allows people to borrow at much lower rates. It's at base rate in the economy, is what all other interest rates are really tied to. That being said, we've seen much more in terms of the asset purchasing from the Federal Reserve, which is really non-traditional monetary policy, but still part of the policy toolkit that the Fed has. And that part has been hugely impactful on financial assets. The Fed is directly buying financial assets at a scale that really we've never seen before. First thing they bought were mortgages. Then they sort of continued to, on the path, bought their own treasuries across the yield curve, but then at the same time extended out into other types of loans, investment grade credit, and dipping even in some cases a bit into the high yield credit space, which is really without precedent. We've never seen anything like that. The goal there is to keep lending rates down for companies. And so the goal is ultimately consistent with and to provide liquidity, allow for borrowing to happen, allow for really a functioning economy. So it is consistent with what the Fed's mandate is. At the same time, though, the scale and the scope is really without precedent, and it's been pretty impactful for financial assets and creating some of that disconnect between what we're seeing in asset prices and the rest of the economy.
Right, and so the logic there, I imagine, is if the Fed weren't buying assets, they fear that that would lower the confidence of other investors.
Yes, yeah, and it's designed primarily through bonds, basically to keep borrowing costs low, and so it's quantitative easing. That's what you've seen across and yield curve control is another term that gets thrown out there. But that's what we've seen in the past in terms of the asset purchasing programs, where the Fed wants to keep government borrowing costs low, but now extending that to corporate borrowing costs, and by directly buying their assets is sort of a new scale, a new wider scope in terms of what the Fed can do, but also a new scale when you look at the size of the Fed balance sheet and the assets that they hold. That has expanded massively, really in a way that we haven't seen before. And the goal is to fill in this massive gap in terms of economic output. And there is sort of a massive financial hole that needs to be filled. But these are extraordinary measures to fill that hole and to bridge that gap until the economy can sort of get back on its feet and we can start to see economic growth again.
Right. Yeah, and from a consumer side, it's okay, not only are people cautious for their own health purposes, so they're not going out and buying things quite as much. They're not out and about in the community, going to restaurants, going to the movies for their own health reasons, avoiding being infected. But then you also have the fact that maybe people are a little bit more wary of spending money because they're not certain, they're not as confident about job security or the health of the company that they're working for. So maybe they're being more conservative with what they're doing with their own funds than they were beforehand. So you have hibernation of the consumer from just a lifestyle standpoint, but then also the cautiousness of, okay, I'm gonna button my spending up a little bit until this kind of passes. And then that happens at scale, and now everything is just slowing. And then you realize the kind of domino effect of what happens when that does happen at scale for an economy and for a market. Hence the government's kind of emergency behavior with trillions of dollars into the economy in whatever it's been, 6 weeks.
Yeah, and that's been, the response has been without precedent. And each of those things you point to, you see these economic data points that really jump off the page in terms of the savings rate. Those have massively increased. We're just going to see spending decrease massively. The economic shock is real, and the unemployment rate above all has been the most massive increase that we've ever seen. And that isn't going to be an easy thing to rebound from. There's no easy restart to the economy. But I think it's important to also realize that the economy is built to adapt, and there will be ways that we learn from this experience, and there will be innovation that comes out of that it's ultimately going to drive our economic growth. The engine for economic growth, it is still intact, and that's built on time-tested human ingenuity. That's what's going to drive us forward to a new economy. We just at this stage don't know what that looks like exactly, and I think that the road to get there, it won't be easy, but it's been done before. We've recovered in the past from lots of different financial crises. It is ultimately that human ingenuity that will drive us forward, and there will be innovation and new ideas that play a key role in all of this.
What do you think is going to happen over the next 6-12 months? What do you expect to happen on a macro scale?
I think I can comment on it, but obviously I have no crystal ball. And I think that that's an important thing to highlight, because with something as unpredictable as a virus, there is a wider set of potential outcomes. There could certainly be another leg down in terms of markets. There could certainly be further spread of the virus. There could be a second wave, and I think that those things are definitely potential outcomes as we try to restart the economy. But given that markets are in the long term resilient, and I think there are fundamental reasons for that, and as we come out, the trajectory will be different. There will be different things that grow, but we still have the fundamental human capital in place, the American ingenuity on one side, but it's really the global ingenuity of human beings being able to adapt to a new environment and carry us out of whether it's an economic crisis, a health crisis. People ultimately adapt to this new environment, and they will to a level where we can grow again. But yes, it's not easy.
Not easy. And from what you've seen, and what types of companies, what sort of societal or individual behavioral things do you expect will stick around as a result of coronavirus?
I think there are structural changes. A lot of those changes that had been in progress have been accelerated. So things like Amazon, where you're buying things online, trend in e-commerce was not new, but it's now been accelerated massively. Then, on the flip side of that, other large companies with the ability to weather this financial storm, they've been able to further their advantage and take advantage of some of those demographic changes, those shifts in terms of people's preferences. Places like Netflix obviously have had record numbers. Those companies that are using technology to their advantage, I think those trends only can accelerate through this, and we're seeing that the use of technology, the use of work from home technology in particular, those things I think are here to stay as we have kind of an unknown time frame for how long we're going to be working from home. We're going to be not really sheltering in place, but having a sort of an unclear restart and an uneven restart to business activity and to just general human activity.
How do you expect, so a couple of questions related to assuming the kind of slowdown persists. Question one is, what do you think the government will do? And question two is, what are the long-term implications of the giant stimulus, multi-trillion-dollar stimulus, the banks giving out a lot of loans, inevitably, some of which won't be repaid, the fact that we already do have monster debt as a country, and as do a lot of other countries?
Sure, and I think that's been a key theme in terms of what's happened with all this stimulus. Someone has to pay the bill at the end of all this. The money doesn't really come from nowhere. There can be effectively some money printing where we reduce the value of our currency. That's the likely outcome, is the least painful, but there has to be some level of pain. There have to be losses taken somewhere in order to make up for this huge deficit where we're now borrowing at a scale that we've never seen before. There has to be the ability to pay that back at some stage. So I think it's a long-term debt cycle. We will ultimately restructure this debt. There will be defaults in some cases, but over the long term, we're extending out the duration of that debt. That's the likely scenario path moving forward. But as to who ends up paying it, I think it's going to ultimately rely on the ability to pay in many cases, where we have the largest gap in terms of wealth that we've ever seen, and it's going to be very difficult for a lot of people to assume the cost of that debt moving forward. So I think that's probably the theme, the struggle as to who pays for that debt. That's going to be a theme for the next decade or so, as to how we actually work that out.
And then, with certain cities are easing the lockdown, so in theory, that could potentially lead to more activity and restoration of economic health. But obviously, there's the concern that we just have a backlash of a rise in cases again, and we're back to square one. So we're sort of on the cusp of that happening. I think there's still so much to be determined as we enter a kind of new phase of poking our head back out.
And I think, touching on what you'd mentioned before in terms of long-term impacts, in cities, we really do have the largest, experiment happening in terms of how we restart the economy and where we can restart. And I think that will have an impact on the way people interact, the way cities are designed, even architecture in cities, adapting to a new environment where social distancing has been key. And I think that we'll see some of the changes coming out of the pandemic happening first in cities, where we've seen really the hardest hits and the largest changes to people's ways of life. So that can be the way that cities are designed, the way that public parks are used, the way that that people live, how close they live together. I think the density of population, and also the makeup of cities in terms of whether their populations are older or younger. I think places like New York, the population, because of the risks, it's likely to skew younger coming out of a crisis like this, and that will change the demographics of cities. So those are some considerations, but there are tons of different unknowns there, and even with that being said, there's things could go back to normal in many ways, but have other changes that we don't necessarily expect. I think that's going to be something that we learn from pretty substantially moving forward.
Yeah, and there, obviously everyone's scenario is different, and some people have been much more adversely impacted by this thing than others. But it's been interesting in the quote knowledge economy, jobs that previously had offices in downtown Manhattan or paying a hefty sum for monthly rent on a corporate office. Now people realizing, oh well, we can just do this job from our home. We can do it from our laptop. And what does that mean, for corporate leases on these skyscraping buildings in cities around the world? Are we going to continue to do that? Or on the other side, a small business owner who was previously just relying on foot traffic, now adjusting, getting a Shopify account and starting to sell their stuff online just as either a complement or a complete replacement for their previous brick and mortar. I've spoken with a lot of my friends in New York who are small business owners, and by necessity, they're adapting to online sales or selling gift cards through their social media or what have you. It's been interesting as a kind of shock to the system is how our business is adapting.
Yeah.
How are all of us adapting? But
businesses, in terms of how they're adapting, I think that is, that's going to ultimately drive change. People will have ideas coming out of this, and that's how we're going to accelerate economic growth moving forward. It's not going to be just going back to the same thing that businesses were doing before. People have adapted things like office space. Businesses will get more efficient if they don't need to be spending all that money on office space. They can allocate that capital differently and move towards other areas where they see growth opportunities. That's the human way. That's the ingenuity that I was talking about before. How that's going to generate growth moving forward is by making those businesses better and adapt it to the future.
Where would you recommend someone begin or continue their own self-education as it relates to economics and markets?
So I think one thing that I've been following and enjoying through all of this has been the way businesses have pivoted and are going to have to pivot. So there's a podcast actually called Pivot by Kara Swisher and Scott Galloway, and that's been a fantastic resource for a lot of the technological change that's happening and how that looks moving forward in what's ultimately going to be a new economy. So that would be one place that I've benefited from pretty substantially. And then trying to think other financial podcasts. There are a bunch of good ones out there. One's called Invest Like the Best, Patrick O'Shaughnessy's podcast. That's fantastic in terms of giving you an idea of how a lot of the best investors out there think and how they're approaching financial markets and what potential risks there are out there, but also opportunities. He does a fantastic job at covering that. And then more generally, on a day-to-day basis, throughout this, The Economist podcast has been a very good resource. It's called The Intelligence, and that's been a great resource for me. And it's, I guess, a more easy to digest bite-sized episode versus some of those longer, more comprehensive things out there.
Yeah, no, thank you for those recommendations. And speaking of that, I'm hoping that you can be our jalapeno economic expert who checks in throughout the year to give us your lay of the land.
We'll see. I'm not sure expert is going to be the best term there, but I'll do my best.
Yeah, and thanks for giving us part of your night. You're a busy guy. You got a baby at home and a mutual fund to manage. So certainly appreciate you taking the time.
Of course, anytime. And yes, hopefully you didn't hear a lot of crying in the background, but yes. That's been a fantastic thing through the crisis, watching her grow. And I think that's one of the nice silver linings of all of this has been being able to be at home and spend more time with family.
Yeah. Amen. Making all of us kind of review what's most important, not to mention for you and for a lot of people, there's more time spent at home as a result of the reality out there, which putting the important things in under a magnifying glass is a good thing.
Exactly. Yeah.
Well, good, man. Thank you again. And anything else you want to say?
No, I appreciate being on here, and I'm obviously happy to talk to you whenever.
Absolutely. And then same here. And listeners, this is Andrew Dassori of Wavelength Capital. We will see you next time on the Jalapeno. Andrew, thank you again.
Thank you, Ty. I appreciate it.
That's it for this episode. That was Andrew Dassori, investment professional, investment aficionado, Andrew Dassori. Thank you for being on the show. Thanks everyone for tuning in. And thank you, Anave Especial, for the music. This is Ty, your host, signing out. We will connect with you next time on the Jalapeno Podcast.